In this lesson, we will look at the general framework of a financial due diligence report. Asset-side due diligence. This process involves scrutinizing various assets to ensure the financial statements reflect the actual state of affairs. It is not just for accuracy, but also to gauge the potential impact on the valuation and future operations. For cash and cash equivalents, you must do the following. Review bank statements, reconciliations, and cash flow forecasts. Verify the existence of cash through bank confirmations and assess the liquidity position of the business. Analyze the historical and expected future cash flow patterns to understand the company's operating cycle. For working capital, you will do these tasks. Examine the historical trends in receivables, inventory, and payables. Evaluate the aging schedule of receivables and payables to assess their quality and potential collectability issues. Investigate inventory turnover rates and the management of inventory levels, including obsolete or slow-moving items. For long-term tangible assets, you will inspect physical assets either through direct visits or third-party valuations. Assess the adequacy of depreciation methods and rates used. Evaluate the maintenance records and capital expenditure plans to determine if the assets can support future business operations. For intangible assets, analyze intellectual property rights, licenses, patents, and trademarks for their validity, legal standing, and contribution to revenue. Consider the amortization policies and potential impairment issues. Verify the ownership of intangible assets and assess their alignment with the company's long-term strategic goals. Impact on valuation. If cash levels are lower than reported, the valuation decreases. Discovering higher working capital or undervalued tangible assets would boost valuation. Overvalued intangible assets, once corrected, might reduce the valuation, reflecting a more accurate future earnings potential. Contractual implications. Contracts should protect the buyer's interests from asset discrepancies. For instance, if receivables are less collectible than reported, you could include a clause for a lower purchase price or an escrow arrangement to cover potential shortfalls. Those clauses ensure that you are not overpaying for assets that might not deliver the expected value. Debt-side due diligence. The examination of liabilities entails a thorough analysis to determine the veracity of the reported figures, from short-term payables to long-term financial commitments. For short-term liabilities, you will scrutinize accounts payable, outstanding expenses, and short-term loans. Evaluate the aging schedule of payables to identify overdue liabilities or abnormal payment terms. Examine recent changes in creditors' terms and assess the liquidity risk posed by short-term obligations. For long-term liabilities, you will analyze long-term debt agreements for terms, interest rates, and repayment schedules. Investigate lease obligations, pension liabilities, and other long-term commitments that could impact future cash flows. Review any contingent liabilities like legal disputes or warranty obligations that may materialize as future outlays. For off-balance sheet obligations, you will delve into commitments not recorded on the balance sheet, such as operating leases or contingent liabilities. Conduct interviews with management to unearth any undisclosed or contingent liabilities. Evaluate the impact of these off-balance sheet items on the company's financial health and future obligations. Impact on valuation. Discovering higher than reported liabilities should lower the valuation due to increased immediate financial commitments. In particular, unearthing more off-balance sheet obligations than anticipated leads to a downward adjustment in valuation. Overall, any unexpected increase in liabilities, short-term or long-term, diminishes the perceived value of a company. Contractual implications. Contracts should include clauses to address those eventualities in case you uncover liabilities not previously identified. It could involve the following. Warranty claims. Stipulate that the seller is responsible for any undisclosed liabilities that emerge within a specified time frame. Escrow funds. Set aside a portion of the purchase price in escrow to cover any unforeseen liabilities. Post-closing adjustments. Include terms for adjusting the transaction value based on actual liabilities discovered post-acquisition. These measures ensure the buyer is safeguarded against potential financial risks arising from undisclosed liabilities.